Welcome back to Smart Stock Sam, the channel where we cut through the noise and final real hidden signals from data so you can actually stay ahead of the market moves. And today, we are going deep on one of the most explosive, most talked about, most debated stocks on the entire market right now, POET Technologies, ticker symbol POET. Here is the setup for today. A single public interview from a company executive allegedly torched hundreds of millions of dollars in market cap in one afternoon. A semiconductor titan walked away and canceled every single outstanding order overnight. Class action lawsuits are now piling up. And yet, the stock just ripped nearly 30% in a single session. So today, we are going to unpack the anatomy of this battlefield stock, the catastrophic crash, the jaw-dropping rebound, the hidden institutional accumulation quietly happening while retail investors were running for the exits, and the 3 make-or-break calendar dates that will determine whether POET is the greatest comeback trade of 2026 or a value trap with a ticking clock. Stay locked in because this one moves fast, and so does the stock. Let us start with the price action because honestly, nothing tells a story like the chart does. At the beginning of 2026, sentiment around POET was electric. The company was riding massive optimism around their optical interposer technology, a breakthrough that positions them squarely in the heart of AI data center infrastructure. Shares hit a high of $15.50, fueled by pure momentum and institutional enthusiasm. But then came April 27th. In a matter of hours, not days, not weeks, hours, the stock suffered a catastrophic 45 to 50% decline. That is not a dip. That is not a correction. That is a full liquidation event. Panic selling, stop losses triggering in chains, margin calls, the kind of session that leaves retail investors completely shell-shocked. But here is where it gets fascinating. Just when the obituary for POET was being written, just when the bears were celebrating, the stock came back swinging. On May 5th, POET staged a massive 30% recovery, closing at $9.21 on heavy accumulation volume. This was not a dead cat bounce. This was a war between retail panic and professional institutional repositioning. So what lit the fuse? What turned a stable tech player into a falling knife in a single afternoon? It all traces back to April 21st. The company's chief financial officer, Thomas Mika, gave a public interview where he allegedly breached non-disclosure terms relating to the company's commercial relationships. The fallout was instant. 6 days later, April 27th, Marvell Semiconductor, a true titan in the space, abruptly canceled every single outstanding order they had with POET. Not some orders, all of them. The market's reaction was textbook. Sell first, ask questions later. The stock cratered. But then, look at that green bar on May 5th. A nearly 30% surge in a single session. That does not happen by accident. That is intentional buying. And we need to talk about exactly what drove it. 3 structural forces pushed that price back up. First, broad sector momentum. A wave of positive sentiment around semiconductor innovation and easing geopolitical tensions lifted the entire chip space. POET rode that wave. Second, speculative backfill. Rumors began circulating, and I want to emphasize rumors, that POET was already in active talks to secure replacement orders to fill the massive Marvell-sized hole in their revenue pipeline. Could that actually turn into a real announcement before Q1 earnings? That is the kind of question that gets traders salivating. Third, and most interesting, aggressive options demand. Professionals were not just buying the stock outright. They were sniping the July 17th $9 strike calls, positioning heavily ahead of the upcoming Q1 earnings release. When you see that kind of targeted, high-conviction options activity, it means the smart money is not just dabbling. They are making a real bet. But before you get swept up in the rebound excitement, we have to do an honest gut check on the fundamentals, because the balance sheet tells a story that demands your full attention. Full year 2025 results show just $1,070,000 in total revenue against a staggering $63 million net loss. That is a disconnect, a severe, glaring disconnect between the company's market cap and their actual commercial traction. If you are a pure value investor, those numbers alone will make you run. But here is the critical variable that changes the entire thesis. POET is sitting on a $430 million cash reserve. $430 million. That is a war chest. That is a runway. That is the difference between a company that is fighting for survival and a company that has the financial oxygen to pivot, to execute, to iterate, and to outlast the short-term noise. That cash effectively takes bankruptcy off the table in the near term and gives management the time they need to prove their technology works at commercial scale. And speaking of scale, management is not flinching. Their production goal for 2026 is to deliver over 30,000 optical engines, building real market presence from the ground up. They have already secured strategic manufacturing partnerships with Litian Technology and Lessengers to support that ramp. But the crown jewel, the product that could genuinely change the entire narrative, is the 1.6 terabit 2x DR4 next-generation module. This is a cutting-edge AI data center component, and sampling is slated for Q2 of 2026. Think about what that means. If POET can demonstrate this technology works at scale, if the sampling goes well and major hyperscalers take notice, the loss of Marvell could literally become a footnote in this company's history. Could we be looking at the next great AI infrastructure play, or is this just an expensive science experiment? That answer is coming, and it is coming soon. But before we get there, we have to talk about the legal hurricane that is currently making landfall. Multiple law firms, including Rosen Law Firm and Brager, Eagle, and Squire, have initiated class action lawsuits against POET. The allegations are serious. First, they claim the company misrepresented its passive foreign investment company, or PFIC, tax status, creating what plaintiffs describe as severe shareholder distress. Second, and arguably more damaging to credibility, the suits allege that management's reckless disclosures directly cost the company its lucrative Marvell relationship. The deadline for affected investors to join as lead plaintiff is June 29th. Now, here is the question nobody wants to answer out loud. What if the legal discovery process uncovers even more damaging internal communications? Because if that happens, even a $430 million war chest might not be enough to stop the bleeding in the stock price. That legal overhang is real, it is heavy, and it will suppress price action regardless of how impressive the technology gets. However, and this is important, the company has a plan to surgically remove at least one of these problems. Mark your calendars for June 26, 2026. Shareholders will vote on relocating the company's corporate domicile to the United States. This is not mere paperwork. This is a structural fix. By moving the domicile, POET eliminates the problematic PFIC tax status that has been fueling these lawsuits and deterring domestic institutional capital. If this vote passes, it clears the tax cloud, reduces legal exposure on the PFIC front, and signals to the market that leadership is taking decisive corrective action. It is the kind of catalyst that can quietly change a stock's entire institutional eligibility profile. And if you think the smart money is waiting for that June vote to start moving, think again. Because while retail investors were panic selling at the bottom, institutions were quietly accumulating. Current institutional ownership sits in the range of 2 to 6%. Still low, still early. But look at the moves underneath that number. Raymond James Financial increased their stake by a massive 75%. Private Advisor Group LLC just opened a brand new $2,700,000 position. This is the classic Divergence playbook. The headlines are ugly, the retail sentiment is bearish, and institutions are walking through the door with conviction. That is not a coincidence. That is positioning. Now let us look at whether the technical chart actually supports this institutional optimism. Despite the April crash, despite the brutal 45% drawdown, The technical signal is currently reading as a strong buy, and here is why. POET is holding above its critical long-term support structure. At $9.21, the stock sits comfortably above the 200-day simple moving average of $7.50. The RSI is sitting at 67.25, approaching overbought territory, yes, but currently signaling aggressive positive upward momentum. The trend is actively trying to repair itself, and repair rallies, when they are backed by institutional buying and heavy options interest, have a tendency to overshoot expectations. But there is something hiding beneath those clean public numbers. The reported short interest of 8.14% looks manageable on the surface. You might look at that and say, no squeeze potential here, move on. But dig deeper, because that surface number is deeply misleading. The off-exchange short volume ratio is sitting at nearly 49%. That means nearly half of the short side pressure on this stock is coming from dark pool activity. Institutional bearish bets placed in off-exchange venues that never show up on your standard ticker app, never appear on your retail short interest dashboard, and never get reported in the headlines. There is a massive iceberg of hidden selling beneath the waterline. And here's the critical question the bears are not asking loudly enough. When that position eventually needs to cover, and all short positions do at some point, what happens to a thinly traded float like POET's? Could we see a squeeze that makes the May 5th 30% move look like a warm-up act? I will let you chew on that one. On the option side, the sentiment is unusually skewed in the bullish direction, and it is the kind of skew that professional traders pay close attention to. The put-to-call ratio sits at 0.38, heavily bullish. Implied volatility is running at 138%, which tells you the market is pricing in massive swings ahead, and we are seeing million-dollar turnovers in the January 2027 $12 strike calls. Real money, big bets. Traders are literally positioning for this stock to recover into the $12 to $13 range within the year. Is that realistic, or is that pure speculation riding on hope? The next few weeks will start answering that question. So how do you actually trade this chaos? Our stance is selective bullish, but with discipline. The entry zone is $8.50 to $9 even, aligning with current support structures. Your downside protection floor is $7.50. That is your 200-day moving average, and you do not want to see a close below it. On the upside, resistance sits at $9.30 and then $10.50. Break those levels with volume, and the target altitudes become $11 in the short term, with $12 or better as a realistic end-of-year scenario if the catalysts line up. And those catalysts, let me give you the 3 dates that matter. May 13th, Q1 earnings. This is the first major test. We need to see confirmation of that rumored $5 million replacement order and any forward guidance on the 1.6 terabit module. June 26th, the corporate restructuring vote. A yes vote clears the PFIC cloud and opens the door to broader institutional eligibility. A no vote is a significant negative catalyst. Be prepared for volatility. June 29th, the lead plaintiff deadline for the class action suits. This date consolidates the legal opposition and gives us clarity on just how large and organized the legal exposure will become. These are binary events. They will either propel this stock back into double digits with momentum or crack the foundation further. There is no middle ground here. So here is the bottom line on POET Technologies. This company sits at a genuine inflection point. The $430 million cash cushion prevents near-term bankruptcy and buys management the time to execute. The next-generation technology is real and potentially transformative for AI infrastructure. Institutional accumulation is quietly happening against the backdrop of terrible headlines, and the technicals, for now, are holding above the critical floor. But the credibility damage from the CFO's interview is real. The Marvell cancellation is real, and the legal overhang is not going away quietly. As long as the price holds above that $750 200-day average, the weight of evidence points toward continued recovery. But this is emphatically a high-risk, high-conviction trade. not a passive hold. Before we wrap up, a quick but important note. Everything discussed in this video is strictly for educational and informational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Always do your own due diligence, consult a licensed financial advisor, and understand the full risks before making any investment decisions. Markets are volatile, and past performance is never a guarantee of future results. All right, Smart Stock, Sam family. That is your full breakdown of POET technologies. Now I want to hear from you in the comments. Do you think the $430 million war chest is enough to weather the legal storm and fill the Marvell gap before the cash burn catches up? Yes or no, and why? Drop your take below, because this community has some of the sharpest minds in the game, and I genuinely love reading your analysis. If this breakdown gave you value, hit that like button right now. It makes a massive difference in helping more investors find this channel. And if you are not subscribed yet, what are you waiting for? Tap subscribe and ring that bell so you never miss a deep dive. Finally, if you really want to show your support and help us keep producing content like this, you can send a super thanks directly through YouTube's support feature right below this video. Every single one means the world to this channel and this community. Stay sharp, stay smart. I will see you in the next one.